my project return. What has that done to my levered return?
Was.
It's made it negative. Now, let me do something. Let me make my cost of debt 16.43%. I should still have a positive, albeit very small positive, levered return. Well, it didn't work here for some reason. But in theory, if my project return is greater than my cost of debt, I should have benefits to leverage. And for some reason it's not happening here, but it should. Okay? But you understand what I'm saying? Okay? I don't know why, but let's see. And again, I shortcutted this. Let's make this just 16 to say something. Okay? It's still not happening for some reason, okay? That doesn't make sense because at 1645 it was higher than that, but whatever. Okay. Anyway, let's just undo. Okay. I put you back where you were. There you are. Okay. Now, so that's all positive, but what happens when things don't go the way you plan or expect them to go?
Here we've got some other tables, right? The effects of similar type of comparisons, right? Before we looked at, the effect of interest rates. Now we're looking at the effects of changes in NOI. Now, what can affect NOI, right? If we're in a cycle that's declining and vacancies go up, right? You figure your pro forma on 5% vacancies, and now you're in a condition where you've got, 10, 15% vacancies. That's going to affect your NOI, right? Your NOI is going to go down because you've got less money coming in. So how does that affect the overall thing at different LTVs? This table kind of, shows you that. So, right?
Well, yeah. See, this is critical. So let me pull mine out a second.
Yeah.
Okay? Because listen, the point is, we just showed you why leverage was great. But the problem is cash flow doesn't always stay constant, and that's the lender's problem. The lender's concerned because they're the ones at risk. In a non-recourse environment, who's got the risk here? The lender's got the risk, right? And so the problem is there going to be sufficient cash flow available in order to service debt? There are a lot of things, as Ben says, that could go into that. Cost of living increases aren't what you expected. Vacancy rates aren't what you expected. Credit losses aren't what you expected. Operating expenses, or the pass-through of operating expenses, or the recovery of operating expenses isn't what you expected. Right? Market rents aren't what you expected. And all of a sudden, now it's 2008, and you're releasing, and market rents are down 30%. They didn't go up 3%, they went down 30%. Wow. So, my vacancy isn't at 95% anymore. I'm sorry, my occupancy is not at 95% anymore, it's at 85%. 3 tenants went out of business. Or they downsized themselves away, they went back to another warehouse. Okay? And so, let me see if I can just change this here.
I changed the one in the middle.
Yeah, but let me just do this. The table's not giving me what I'm looking for. So let me just pull out another.
That's fine.
So I just put one together. It's a similar spreadsheet. Ben did a nice job in manipulating his, but looking at a similar example is, and I didn't have all of the variables that he had, but you could clearly see in this scenario where a 15% degradation in net income, a $15,000 degradation in annual NOI, all of a sudden took me from a 10% return to a negative return.
And you also have another problem now that you've leverage this property, and chances are that property values have decreased, right?
Well,
So now you have a not so liquid asset that you can't really get rid of because you owe more than.
well, or definitely have less to
work with.
defend, right? Because the lower the NOI, all other factors being equal, the lower the NOI, the lower the property value. So it's great to see that as we pile on leverage, we get a higher return. But when we have negative factors affecting our income,
It lowers it.
well, to the point where we wind up with negative returns, right? And so you start saying, if you impact my income enough, I'm going to start having negative returns and I'm not going to be able to service debt. Okay, and so that's why debt brings volatility, because it gives me these great returns if incomes go up, but it gives me some very adverse effects on the downside if that's impacted in any way. Okay, I sent that spreadsheet out, Ben, in last term on how to build data tables.
No, yeah, it was.
Are you going to share that?
It was hard coded, most of the stuff, so I had to unhard code it and then set it up.
No, the one that I just showed is not the one that I sent you. It's one that I had sent out. I sent that out last term. Were you not in my classes last term?
I never got that spreadsheet.
Did you take the accounting class?
I did.
Did you watch the video where I walked through it?
I did, yes.
Okay.
But
Jason, you had a question?
No, I
here's the same type of table for cap rates, right? So, you know, you
Are
saw
these going in or coming out?
these are going out.
Okay.
So when you go back to the top of the spreadsheet, which I'll shoot up to real quick, you'll see that we had a section here where we said resale assumptions, right? We're going to sell this thing at year 10. We're going to assume that the cap rate is going to be 7% cost. That ties into, you know, this part down here, the resale schedule, right? What's going to happen each year if I sell it at year 1 or year 2, year 3. So when you come down to this table, you could kind of see what the impact is if that cap rate assumption wasn't right. What if it's instead of 7%, you know, it's, you know, 4%, you know? What if the cap rates go up, right? That make sense?
Yeah, no, or listen, the real risk, right? So if we talk about bottom risk, right, or lower tail risk, the risk would be that cap rates go up, right? Which means values would go down because there's an inverse relationship. So when you do a sensitivity analysis like this, you say, okay, you're always happy to have upside risk, right? But the risk that I think you talk to here, which I think is important to know, is when you model, and you need to have a good sense of the spread that exists between going in and exit caps. And one of the major pitfalls in modeling, okay, is when we have scenarios in which a large part of the internal rate of return is driven by capital appreciation, and that capital appreciation comes from people who are modeling lower cap rates going out than what they're going in at. So again, implication that for some reason lower rates are going to go down, cap rates are going to go down. It could be that interest rates are going down, and maybe it could be that you made it an A- property, an A property, or a B+ property, an A- property, and you get that juice. But the concern obviously is how much of your IRR is coming from that exit cap or that spread between going in and coming out. So
So I mean, I guess in conclusion here, I couldn't get this last part working, so I'm not even going to try to cover it. But in conclusion here, I mean, you know, it's important to understand, you know, we make certain assumptions when we're modeling and putting pro formas, and we're thinking out 7 years from now, 10 years from now. I mean, you know, we've got to assume our cap rates, we're assuming our NOI, we're assuming our vacancy rates. We have to understand what our exposure is if these variables change. You know, market conditions, NOIs drop. So you know, when we put something like this together, which is, you know, fairly easy, right? I mean, if you haven't taken the investments class, the real estate finance class. I mean, you're going to learn this here, and it's going to become, you know, fairly, you know, potential, effective, gross. You're going to get that down, and you're going to be able to do that. And it's important to know these other factors that you're assuming and how they're going to affect your investment. So that's it. Any questions?
Thank you, that was very good. No, leave it up a second. I wanted to show one other thing, which again is outside the, well, it's just, so, I don't think you've got the plumbing, I don't think you've got the plumbing to do it inside this spreadsheet, because I don't think what I sent you had the plumbing to do it.
So I was trying to mess around with the CPI stuff, but I couldn't find out where to link it back to, because in your spreadsheet you had it linked to like a blank cell for the CPI.
Well, because this is somebody's, and when I wanted to make the quick example, I just shortcut straight to NOI.
Yeah.
Because your CPI thing ultimately is talks back to any number of factors that affect NOI. So, but I disabled something. But what I was going to say, which is going back to Marianella's discussion earlier, okay? Built properly, a spreadsheet like this also allows you to do sensitivity on IRRs and figure out when the optimal period is to sell an asset. Because you remember, IRR has two components in real estate, right? It has current income, but it has capital appreciation. And so, again, depending on how this flows in, lease expirations, bumps, periods in the building is dark, so the releasing assumptions that we use, the CapEx that we invest in releasing and retenanting buildings, this type of analysis allows you to target an optimal period in which to sell, given all of those cash flow factors that impact our ultimate return on an asset.
I'm sorry, what is CapEx again?
Capital expenditures.
Okay.
So CapEx on real estate are TI, BI, leasing commission. So leasing and tenant improvements, building improvements, and leasing commissions are the big ones, okay?
But again, that's one of the components. I mean, but it is a lot of them that ultimately going to tell you when to sell, not just the IRR.
No, absolutely. But going back to, and unfortunately, the plumbing here has to be set up properly in a way that you can actually build a data table on it. And the way it is right now,
Yeah, no, I mean,
because
we could put an IRR here and then type to the cash
well,
flow,
you
the
could do one like that, but
Yeah.
but you can build. I'd have to go back to one that Jesse had given me some years ago, where you've got to have the plumbing right that you can then build a data table to do that kind of sensitivity analysis. Okay, and there's a bunch of conditional statements you have to put into it. So I'm not prepared to talk to that right now. But the concept is what I wanted to mention, which is when you take a look at that and you see, well, what are my potential? You definitely got the data here in order to do an IRR at every period, but
Yeah.
you can't stress it. You can't do the data. You can't do the data table on it. Okay, but that's okay.
No.
It's the information that's there. Thank you, Ben. Very good. Thank you. Any questions on this? But again, look, leverage is clearly the most important, I think, component of why real estate makes sense. Okay. Now,
Great.
no break. No, because we got.
Professor, before you go, can you talk about the midterm and the final before the end of class?
The midterm or the final?
Both. I mean, the midterm was done. But
Yeah, I unfortunately, as I said, I think all of you already, I couldn't grade the midterm because the window I had, I didn't have all the submissions in. So I just
Did you
don't,
grade mine?
let me repeat what I just said.
Yeah, mine was within the window, so.
Yeah, but unfortunately your professor doesn't have the time to grade one and put it aside and grade another and put it aside. I gotta do that in one sitting. That's what's effective, right? And believe it or not, it's what's effective for the students because it allows me to gauge relativity. So I don't want to get into Einstein's or San Miguel's theory of relativity, but it tends to help students. When things are relatively not up to the professor's standards, he tends to be more considerate of some of the submissions he's getting, okay? So my goal is to get that done before Thanksgiving and to have a grades to date summary to all of you before Thanksgiving, okay? If you would like, what I can do, which would be helpful, is I will go through over the next 30 minutes, which is one of the things I wanted to do today, the sort of top level or overall answers for all of the questions. I said at the beginning, not all of you were here, count on the final being in class on December 10th, okay? We'll get through all the material we need to get through in order to have that. Before I do that, I did find this. I said the other day that I wish I had this. Real interest rate. So I got from The Economist, September 24th. Historic Bank of England base rates since the 1700s. So, disregard the period from 1970 to like 1980. And there was a lot of stuff going on, okay? You know, the pound took a beating those years and all that. Historical interest rates have been between 3 and 5% for 300 years in England, okay? If you take a look at world real interest rates since 1985, they have dropped, real interest rates have dropped, worldwide have dropped from 4%, which makes sense in 1985, 4%. I'd said historically in this country it was like 3. There they say 4. Okay? Across the world. It kind of makes sense. It sounds intuitive to this year across the world being negative. Okay? And we've talked about, you know, what's going on in the world today with negative interest rates and all that. But again, I just wanted to share that with you because I found that. Okay. Question number 1 on the test was, explain the existence of financial markets and how they improve efficiency. So, we talked about facilitating the transfer of funds from users to savers. We talked about being able to mitigate some of the risks that are associated with that. Okay, so we talked about from a macro perspective, operational benefits, allocational, informational, and pricing efficiencies. From a micro level, we talked about volumes, being able to match the right dollar amounts, liquidity, maturity, and risk, okay? So those were kind of, okay? In addition to that, the intermediary in the financial markets and the intermediary, creation of the intermediary also facilitated price discovery, okay? Reduced transaction costs and facilitated a payment mechanism. Yeah? Question number 2, explain the role of financial intermediaries and how they provide at least one of 4 economic functions, okay? So, again, we just talked about they provide a payment mechanism, so that's easy, okay? They provide maturity, intermediation. They talk about essentially the micro efficiencies of financial markets. Maturity intermediation, risk reduction via diversification, and reducing the cost of contracting and processing information. Okay? Discuss the fundamental principles of the valuation of financial assets and its implications on real estate. And explain how market forces transform such values into the market clearing process. So, we talked about valuation of a financial asset, right? So we kind of go back to, say, fundamentally in 1938, John Burr Williams said that a financial asset was worth nothing more, nothing less than the net present value of its future cash flows. That involved a process in which we mechanically forecast, we calculated a discount rate, and we brought it back to the net present values. And where that sort of goes in equilibrium or translates in equilibrium into market clearing prices in real estate is that assets, buildings, will only trade at the net present value of their future cash flows because no willing buyer would pay more and no willing seller would accept less than the net present value. Now, obviously that's an equilibrium and that's theoretical. If you look at the spreadsheets that Ben just put together, we may have different perspectives on what future cash flows are. We may have different assumptions as it relates to CPI. We may actually have a different cost of capital, okay? And so there may be reasons why we have hiccups, but in a deep and broad market with multiple players and in which there is efficiency of markets, right, in which all information is known and widely and freely available and essentially built into asset pricing, we shouldn't have major discrepancies, okay? And I think from personal experience, if you were to take a look at it, an institutional asset sale, I mean, this is a very, very normal scenario. 30 people might ask for a book and walk around a building. Out of that, likely somewhere between 15 and 20 are going to make bids. Do you have a sense? This is not empirical. This is purely anecdotal. San Miguel, you know, anecdotal, okay? But I can tell you, do you have a sense for what the distribution of that might be? Assuming that the ultimate sales price is $20 million, you know what you're likely to see in a scenario like this? You're going to have some crazy guy that's at 15, okay? And you might have a couple of other bottom fishers at 16, or, you know, 16.5. You're going to have the bulk of these guys, 13 of these guys, 13 of these, 15 of these guys are going to be anywhere from, say, 19.8 to 2100. And why, you ask? Because the seller's making all this information available to people. In most of these cases, they're already even doing most of the due diligence for you. They've already done the building inspection report, okay? They've already done environmental. They're putting it all in a data room. They've already given you an Argus run with the lease assumptions there. They're chewing it up for you. In a lot of cases, the intermediary is already coming with financing in place, saying we'll loan up to X amount at X. So you're just not going to get that much dispersion. Okay? So anyway, so that's question number 3. Question number 4 was detail the weighted average cost of capital. I did that earlier today, so I'm not going to do that one again. Okay, we did that one already. Question number 5, explain the major difference between commercial banks, SNLs, credit unions, and explain the historical involvement in real estate finance. One of the things I was saying in my cursory reading as they were coming in, there were 2 or 3 of you who had that question. I got major differences. I didn't get the second part of the question, which is what was their involvement historically with real estate. So, so basically, depository institutions accept deposits and make loans. Commercial loans typically deal with corporate users. They typically deal with demand accounts. They tend to match assets with liabilities, variable rate liabilities, variable rate loans. SNLs, which don't exist that much anymore, tended to deal with investors, individual consumers. They tended to, and let me go back, the commercial institutions tend to do a fair amount of construction financing and some level of midterm stabilized building financing, okay? SNLs, all individual, passbook savings, you know, they paid you 3, and they were huge providers of mortgage financing in the US. That's kind of all disappeared, but they were the core of financing for residential real estate in this country. And SNLs, and credit unions historically are the lenders of last resort, okay? They're not motivated by profit typically, they're there to provide services for the lender. They provide a tremendous amount of consumer credit, but historically not so much home financing. Historically more in the ways of car and other installment loans, credit card financing and things like that. How do banks, financial institutions generate earnings? Well, the single biggest one is spread on margin. They borrow at 3 and loan at 6, go home at 4, you know, something like that, you know. So that's historically it, but they also make money on fees that are charged, so it's not just like, yeah, there'll be like this fee on this loan commitment, but, servicing fees and things like that, okay? And, ultimately now, they also get involved in, swaps and things like that where they could make a little bit of money. Risks involved with them, credit risk, default risk, regulatory risk, liquidity risk,
How do they make
interest
money
rate
in
change.
swaps?
Sorry?
How do they make money in swaps?
Because there's a fee embedded in that. They're gonna charge you to underwrite a swap, they're gonna charge you money for that. They're not gonna go and do a swap deal if they're not gonna make money on it. So they're gonna, and likely make a spread as well, okay? There's operational risk, there's legal risk, there's a lot of risk there. Life insurance, that was an easy one. Life and health and property and casualty. Life and health have long-term views, they take money to pay out long into the future. Property and casualty assume property risks today, short-term, they make a lot of money on investments. They have to be liquid because we don't know when things are going to happen. There's very little predictability. As a result, life companies are big investors in real estate as both providers of debt and long-term equity investors. P&C companies historically are not. We've gone through all these things. Differences and similarities between ETFs and mutual funds, and explain the economic functions that they provide. So both are essentially entities that are governed under the Investment Company Act of 1940, but they basically pool investors' money and provide a vehicle by which people can diversify their investment. So they can be actively managed or passively managed. So a lot of different ways to tackle this question. It could be actively managed, it could be passively, and just track an index. There's a concept of net asset value, which we talked about in the context. The key differences are the context of net asset value in a mutual fund is set every day at 4 o'clock. ETFs, net asset value flows, and it trades on an open market during the hours of the market. And as a result, there may be a discrepancy between net asset value and the trading value. But the single biggest reason is, or the single biggest difference is, one clears only once a day, the other one clears at any time during the market.
If it deviates too much, someone buys
Then there's an arbitrage opportunity there for someone, presumably. Now, the problem is there's no guarantee it ever settles at that NAV. And whether it's above or below, you can trade. You can short, you can go short, you can go long. You can buy or you can sell. What are hedge funds? So hedge funds are pools of money. They are not governed under the Investment Company Act of 1940. It's for qualified investors. They do a lot of different things. Typically, they don't hedge. They have specific trading theories or objectives, okay? So some will be directional. We expect the market to go up, and they'll pile on using significant amounts of leverage. They might, be opportunistic as it relates to transactional arbitrage. So for example, the Tesoro thing that I said the other day. So I sold the stock at 38, but Tesoro agreed to buy at 37.50. Now, why was it at 38? Well, initially because people thought that, well, maybe another buyer will come in or whatever. Details start coming out. There's a definitive merger agreement. It just needs shareholder approval, blah, blah, blah. What's likely going to happen in a scenario like this is that this stock is probably going to settle, somewhere around here. Okay? So a hedge fund can come in, and what will be a typical thing is they'll buy millions of shares of this. Okay? With a lot of leverage, looking for this 25% pop. Okay? And what they'll typically also do is they'll short the buyer, because the implication is the buyer's going to be short-term affected negatively by the acquisition. They're assuming debt, their management's diverted, they've got to integrate, etc. So I mean that's a potential strategy that a hedge fund would use. Okay, so there's a lot of different, some are purely like ARBs, you know, and then they're doing all sort of program trading, and they're looking for that 1 penny difference between what a stock is trading at in London and what they're trading at in New York. And buying a bunch here and selling a bunch there, or doing it the other way around. So, not a lot of regulation. But what is important is that they provide liquidity to the marketplace. And they typically, because they're willing to accept higher risk in exchange for the higher return, will enter into the markets and assume risk that other investors would not. Case in point, who provided most of the mezzanine financing for multifamily developers in the state of Florida in the mid-2000s? Hedge funds. They came in, it was easy for them to get 15 to 20%, and you know, banks were precluded from making those loans because of the risk involved. Some banks had been doing them, and they were under cease and desist orders, but they stepped in and provided liquidity that the market needed. Okay. What is interest rate? We talked about interest rate being this question number 11. What is interest rate? Did I skip any here?
Yeah, the legislative.
Identify 5 major legislative initiatives. There were different ones. I was looking, and again, I'll give credit for any major. I was looking for Securities Act of 33, Securities Act of 1934. I was looking for the Glass-Steagall Act of 1933. I was looking for the Investment Company Act and the Registered Investor Act of 1940. Those were the 5 that I was looking for. There may be some other ones that may have relevance that, if you know, there's good support behind them, that you know, give credit for. I haven't talked a lot about Glass-Steagall
Yeah, what's the deal with that?
in this class, and it's been a lot in the news. So Glass-Steagall Act of 1933 created a separation between what are
Commercial banks, their securities.
merchant banking or investment banking activities, between commercial banking activities and insurance activities.
So the same bank cannot be involved in the 3 of them.
Under Glass-Steagall Act 1933, a merchant bank, an investment bank, a commercial bank, and an insurance company had to be separate entities. The reason for that was because in the crash of 1929, a lot of commercial banking deposits were put at risk because of investment banking activities that banks were undertaking. It should not surprise you that there is, now that's all sort of changed, but there is a historic investment bank, right, known as J.P. Morgan, and there was also a Morgan Stanley, which is strictly or again, that's all been blurred now. J.P. Morgan was a bank, Morgan Stanley was an investment bank. Now that's all changed now. We'll talk about that. We're not going to get to it today. We'll talk about that later. But you know, Morgan separation of activities. Okay, that all over the years was degraded. Okay. At some point, I think in the 1960s, there was the creation of a concept called a bank holding company. And a bank holding company allowed one entity with internal firewalls to have separate and distinct investment banking, commercial banking, and insurance activities under one holding company, as long as there were firewalls that existed between them. The sort of death knell to all that is what was called the Financial Services Modernization Act of 1999, and what that allowed essentially was for travelers and city groups to merge. And essentially what this act did was do away with this, and it said, forget your bank holding companies, you can do everything under one umbrella. You can be all things to all people, okay? And now what people are, sort of the talk now is people are saying, hey, we've gone too far, these lines are blurred, our deposits are at risk, these companies are too big to fail, blah, 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 blah.
What's
Okay?
your position?
Sorry?
What's your position?
Look, I'm a free market guy, but there's a reason why this existed. And I'm leery of this, I'm leery of this. And I think we're humans, and we're greedy, and that's why we have regulations, okay? And those that don't learn from history are doomed to repeat the mistake, and so.
But they're all interconnected anyways, whether you separate them or not.
Whether you separate them or not. So, and, you know, the thing I've always had the argument against is this whole concept of too big to fail. When this was all happening, the Financial Services Modernization Act, and so, you know, we've gone from, just even in the last 7 or 8 years, from like 15,000 commercial banks in this country down to like 6 or 7. The whole argument behind all that is our companies were getting bigger. We needed bigger banks to support their activities. You know, my concern is you've got too much concentration, and when you look at all the risks involved with regulating banks, for example, operational risk, employee fidelity, business processes, relationships. What happened with Wells Fargo recently? The CEO had to step down. Why?
Because they created a bunch of dummy accounts.
Fraud.
Accounts.
Fraud. So this poor guy's, I say poor guy, the tempo is set at the top. So he looked like a really honest, innocent guy. What knows what kind of SOB that guy really is? I don't know. But the point is, they were asking him, well, didn't you know that all these people at the branch on 15 Montgomery Street were doing this? Hell no, he's got 100,000 employees. So how do you regulate internally? How do you govern? How do you monitor all that stuff? Yes, just operationally, that's an issue. Yes?
And recently there was a new article that came out from the office of OCC.
The controller of the currency.
Yes, where they actually have limited the golden parachutes for executives at Wells Fargo on what that set amount will be now. But of course, the other issue with the whole with the dummy accounts with the community banking within Wells Fargo is that each low skilled employee had to had a metric where they had to had to sell 8 accounts to each customer, when other competitors within the field sold like 2 or 3. So
So if you create unrealistic expectations of employees, you might get unrealistic outcomes, right?
Yeah, and on top of that, in terms of, sure, the CEO does not know at a micro level what every employee does, but should know from their VPs what is going on, and in terms of expectations that cannot be met.
Yeah,
but of course,
yeah,
that's
but
something
I'm gonna give you a personal example, and so, and again, I don't know this guy's stump, or I don't know if he was a jerk or if he was really a legitimate guy and he was oblivious. You get to a point where things happen within an organization when it gets large enough that you really don't know what's going on.
Of course, sure.
I was running a plant with about 400 employees roughly in Rochester, New York. I was there 4 days a week. And I made it a point, 1 day a week I'd have lunch with 5 employees across the board, you know? And I made it a point, when I'd come in the morning, I came in when 3rd shift was leaving and 1st shift was coming in, so I caught that. And I made it a point before I left to walk down on the floor and make sure that I caught the 2nd shift. So my goal was to be visible to everybody, and I was having lunch with 5 different employees every week. So on one day I'm walking the floor, 2nd shift or something, and I stop at a water fountain and try to get water, and there's no water coming out. And so there was a guy, we had like 3 or 4 different collective bargaining units there. The guy that ran the bindery, the guy that was the shop steward for the bindery workers for that union was working the 2nd shift, and he comes up to me and he says something about, well, it serves you right for not fixing the water fountain. And I said, what are you talking about? I don't know anything about the water fountain. And so some employee bitched to a supervisor who said, oh no, San Miguel said not to fix the water fountain, so we're not going to fix it. I didn't know anything about it. And I walked the floor every day. But in the employee's eyes, management had turned their back on them. And I'm just giving you a small example of a small place where I looked every day. Imagine a bank with national operations, 100,000 employees. Yeah, I would say you create unrealistic expectations, you're gonna get unrealistic results, okay? And banks have huge internal audit functions that should have detected. In fact, part of the problem with this guy is that internally they knew what was going on 3 years ago and didn't disclose it and didn't address it. But my answer to the question is I think banks have gotten too big and they've gotten too intermeshed, and when people start talking about eliminating some of the provisions of Dodd-Frank, part of Dodd-Frank requirements talk back to essentially reinstitution of the Glass-Steagall restrictions and eliminate or prohibit a commercial bank from undertaking investment banking activities, okay? And so, you know, when you hear, oh yeah, we're gonna get rid of Dodd-Franks, well, let's walk back and see why did Dodd-Franks come into being, okay? So,
Well, I think that also the fact that we have taken the risk away from them by making them, I mean, if they're too big, they should fail bigly, you know?
well, the problem is when they fail bigly, and it goes back to Ben's
a lot
point.
of people fail with it.
Yeah, well, that's one, but it goes back to Ben's point. I think it was Ben who said it. The problem is we're already in an economy when the federal government allowed Lehman Brothers to go under. It's the fall of 2007. All the dominoes are coming down, and I mean, I thought it was a good decision. Yeah, listen, let's stop bailing all these people out.
Right.
Thing blows up, and then they wound up had to go bail out 10 more, you know, AIG and GMAC and all these others because there's financial transactions are so intertwined that when one goes down,
True.
a lot of people go down.
And it'll be a disaster, but then we will learn, because if people don't get the negative consequences of their actions, it happens at the individual level and at the collective level and corporate level.
And that's a view that's valid in a free economy and free society. And that some people argue for. I mean, I'm not telling you you're wrong. But no, I'm not telling you you're wrong. I'm just saying I understand. My way around that is don't have institutions that are so large that the risks are so large. I would do that rather than regulation, but.
Well, what happens when that happens, then you go to the bank to take all your money out, and everybody in the class goes to the bank to take their money out, and they don't have the money. I mean, that's what happened to, was it Washington Mutual, or?
Well, I mean, there's been several bank runs.
They don't have the money to give everybody their money, so now the whole banking system falls apart.
But the point, listen, the economist for years has argued that there shouldn't be an FDIC type insurance scheme in this country or in any Western country, because then it would force us as investors, because we're investing in debt instruments of the bank, right, the deposits, and taking a look at their underlying financial situation and making us accountable and responsible for our decisions. But anyway, listen, I want to get through the last, 9 questions or whatever. The loanable funds theory, basically interest rate was a postponement, the reward for postponement of,
What question are you?
11. The postponement of consumption, and basically, graphically, kind of goes like this, which is, if you were to graph loanable funds with rates, right, it'd say the higher the rate, the more the supply, the lower the rate, the more the demand, and somewhere in the middle there's going to be an equilibrium, which is going to essentially be the point at which interest rates are set, okay? Address major factors impacting interest rates: maturity, inflation, risk premium, taxability, callability, convertibility, and marketability. Okay,
And that will be the nominal rate, right? You're asking about nominal rate.
Well, that's the nominal rate, because the real rate, in theory, is the rate that prevails in the absence of inflation and blah, 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 okay?
Fisher's law.
Fisher's law, and an example, we did that, so the simple Fisher's law is nominal equals real plus inflation. The real formula is
1 plus n, 1 plus r times 1.
right, so the inflation, right, sorry. And so, n equals 1 minus 1 plus r times 1 plus inflation, okay? theories surrounding the determination of the yield curve, and so.
Were you looking for that numerical answer, or?
I was looking for like a 0.3 and a 0.7. I was looking for an answer. I think I asked for like an example.
Right.
I think that's what the question asked.
I gave you a written example,
So did I.
real life written
Yeah,
example.
that's what I did first.
Yeah,
That's what you asked.
I didn't do an arithmetic, algebraic
Come on, guys, you should know.
example.
I'll shoot you
No, no, no.
I don't know, the question said, explain the impact of inflation on interest rates and utilize your own example by utilizing Fisher's law.
Yeah, okay, so I gave it
That's
verbally.
what I did.
I don't know, I haven't looked at your answers.
Well, I didn't do that.
I didn't do that either, but I didn't get the question. Should be good.
You're all right, man.
You're all right.
How many people got that question in this class? Looks like at least 3.
Boy,
How many got it right?
You got it right verbally.
Come on, you got inputs.
Discuss the major theories surrounding the interest yield curve. And so we talked about liquidity preference, right? And we talked about sort of this indifference or the rational expectations, right? And then we talked about the market segmentation, right? So we've talked about those enough already, okay?
Can you do number 20, please?
I'm gonna do that in a
If
second.
we're going through those.
Rating agencies, 15, I'm almost there. Rating agencies basically, look at company-specific risk, not macro risk, okay? They look at business risk, corporate governance risk, financial risks. They ultimately look at protection afforded to debt holders,
And then they
collateral. They can make mistakes, but I didn't ask that, but you could have said that, that's okay. And the ability to service debt, right, the ability to generate cash flow, okay? There are a lot of different features of a bond. I listed like 30 of them as possible ones. I noticed that I had like some answers with 2 or 3. I was really looking, stuff like, related to how they paid interest, to maturity, to convertibility, to callability, to the type of security that they had, the type of preference that they had, so again, I'll take a look at, but I mean, I had got like 2 pages worth of features related to debt instruments. Advantages and disadvantages of a callable bond. So, ultimately, it essentially provides reinvestment risk or protection against reinvestment risk to the issuer, right? Not to the issuer, to the buyer, to the lender, okay? Because if I return the money to you, right? So I'm the guy who's buying it, right? So in the context of real estate, as we'll talk about in one of the future classes, call protection, affects the lender. It's for the benefit of the lender. But when we're talking about bonds, the lender is the guy who bought the bond. It's the same person. You're just thinking institution versus individual, but it's for the benefit of the lender. Okay. 18, compare and contrast preferred stock and corporate debt, and just talking about the features that were similar and the features that were dissimilar. 19, address the differences between insolvency and bankruptcy, and so we said insolvency was a sort of,
It's a state.
it's a state in which liabilities exceed assets. It could also, a lot of people sort of inadvertently mistake it for bankruptcy, but bankruptcy is actually
A court order.
a
It's a legal-
state,
yeah.
it's a legal state. And there's chapter 7, chapter 9, chapter 11, chapter 13, chapter 15, there's different.
Well, you asked for 3, so was it 7, 11, and 13 that you were looking
I
for?
wrote all these, it doesn't
It
matter.
said 3 major.
3 major, and then there are
I
5.
wrote down 5 so that when somebody,
I forgot I picked the wrong third one.
No, I wrote
I
down,
picked the first 2 for sure. I'm like, does he want 13? Does he
I-
want 10?
I
There are
picked,
3 major.
Yeah,
There are 5 majors.
you gotta pick the 3.
I picked
The one you
5.
had to do with like farmland and shit.
I picked
Did
5.
you give the arithmetic?
No.
I heard it's $1,000.
Preferred stock, preferred stock, I got that one.
No, I did a word thing first, and then I wrote the notes.
Bad for her.
You know, and then I did it.
Yeah, so the value is $1,447. So the first question is it pays 10% and the market rate is 5. So by definition, it has to be a premium bond because the market value is, the market rate of return is lower than the coupon.
Can you do that on the board?
I got
Whoa,
1443 and
Putting it to my
I
off diagram.
And then you,
changed it and messed around and got the wrong end.
okay, but we learned. Okay, so 1,000.
Basically, it's 1,000, the face value divided by 1.05. That was it, times. the
Well,
period.
that, I mean,
No, I just have no idea.
yeah, but we went over the other day, I mean, you could have done it in Excel also. You could have done like the net present value in Excel, right? Or present value in Excel.
How do you get 250 words out of that question?
They don't have to, some,
Did the
It was
math.
250 to 500. So
suggested.
He gave a written answer, not a math.
So how do I deal with it? How do I deal with the answers that were 100 words? When there was room to do two?
I don't think I did 100 words.
No,
I did not do
okay,
honor work
so-
for any of them.
So, the keystrokes on the
I think
HP,
I put
and then,
for every answer too, by the way.
well, let me do it, so it's 1,000 future value, right, with it backwards, right, so you go 1,000,
Just go to 5 keys and.
and then the market rate of return 2i, right, is 5, but it's divided by 2, right, so it's 2.5
That's where I messed up.
I, and then it's 12 years
Why is it divided by 2?
times 2 is 24,
Yeah.
and, right, 24, and then it's 10% coupon, so it's 100, but it's twice a year, so 50
Was it
PMT,
Yeah.
right? 50 PMT, and then present value 14, so you solve for present value 1447, 12, or whatever. Well, I don't know, but maybe your calculator has a different sort of thing or whatever. But like, if I would've seen 1443, then I would've said, okay, you
But
got
I
it
thought I
right.
was, I was definitely wrong,
When
so.
something says that it has a coupon, it means that you get paid $50 a month, is that?
No, a coupon, remember, coupon is what is the prevailing, or not prevailing, it's the interest rate that a note pays, okay? And in this country, what is typical is that most bonds have a face value of 1,000 and they pay the premium on the coupon twice a year. That's just sort of like what's common.
Oh, that's why they call it 50. Because 50.
Well, they don't call it
Semi-annual.
that's why they call it 50, yeah.
No.
Semi-annual.
$1,000 times 10% divided by 2.
Right.
Okay, so, listen, we'll go over a bunch more stuff next week.
So what else do we have in this class? The case studies and the final. Is that what's left?
Yeah, we've got some presentations,
Plus all
so
the
individuals have
crazy
presentations, and then we've got the two Wall Street Journal things are like gimmies, like, you know, and then,
Just wait till he makes them 1 minute.
I mean, so if I make it 5 minutes, at least you have to read the article in advance. You can't like go back and forth. I could also just, what I'll do the next one,
No.
I'm gonna make it easier next time. I'm gonna give you 10 minutes without the link to the article. And then that way, okay. And listen, and we're gonna cover textbook material-wise. We've got this whole segment of the equity markets, asset management firms, investment banks, and then we've got the sort of mortgages, which is a further extension of debt, okay? But just sort of related more to mortgages and to commercial real estate. And that's basically it.
What chapters are we doing for the final?
Final, yeah.
So it's,
Wait, that's next week you're gonna discuss it, right? The final.
no, it's the week after.
Yeah, but you're gonna discuss it.
No, you're gonna talk about it now.
No, I'm not gonna talk about it now. I'm neither gonna talk about it now nor next week. I'm gonna talk about it in class number 7.
Yeah.
This is class number 5, next class number 6, I'll talk about it in class number 7.
And then.
But it's, I didn't bring the hard copy, here, I'll tell you what chapters, if you wanna know what chapters you're
Yeah,
on?
yeah.
Here, I have them. I have them here. You want these?
Yeah, that's what I was gonna look up right now.
The syllabus?
Nobody ever pressed record on the camera?
You can keep going. So it's gonna be chapters 6, 7, 13, and 14,
6, 7,
13 and 14, 21, 25, 27, and 28.
According to the syllabus.
Yeah, no, but that's, yeah, we'll definitely cover all that material in the next 2 classes.
Okay, thank you.
that's nothing.
Would it be in class, is still gonna be an essay type of class?
I'm sorry?
I said, would it be in class, is still gonna be an essay type?
It'll be almost identical type exam, it'll be in class. And you'll be able to bring your computer or do your research here.
No, because I was taking these.
So we can type, so we'll type it on the computer, we'll type it like on.
Absolutely,
It's not.
Ah, so can you do research? Okay.
absolutely.
And we just run you the hand.
You don't like multiple answers?
You bring your cover sheet already printed and signed.
You don't like multiple answers?
Ah, so we can submit it
Like A, B,
online?
C, or D?
When not exceed. Second
Can you
choice.
type it out and submit it?
Eliminate.
You need
It must
to
be,
type it while you're here.
read.
I mean, like, write it or type it?
Type it.
Yeah. I just
So
realized that.
whatever, you have to turn it in, you have to turn it in before, and then you turn it in.
No, it's- I understand, because it's a cash out.
Because I have to do my thing.
Because at the end of the day-
Do this midterm,
When you do,
and I have to do this midterm for this class, it's tonight, right?
or when you do a 10-year projection, right? In year 1, you're gonna pay.
But yeah, no,
$20 million for
midterm,
the
I
fast
got
side,
it
right?
the night before, so I'm like, let's.
You know, you got all NOI and all that stuff here.
24 hours.
I think it's the whole. But also you've got a debt service component.